Hello friends, welcome. Friends, in the last video which I posted around 23 hours back, I saw two comments from my viewers. So one request was to explain the RBI rate cut on the profitability of Bharti, Reliance and Vodafone. Another request was to make a generic video on rate cut. So friends, I have decided to do a video which will take care of both these requests in one single presentation. So before I take you through the presentation, I will like to explain what this rate cut is all about. For that, I'm going to go to RBI's website and there is a tab called current rates. Under this tab, you can see three rates which I'm going to focus on. I'm not going to talk about bank rates and fixed reverse repo rate because those are not important for this discussion, though they have a lot of importance, but I don't want to spend time on these two. So what is policy repo rate? This policy repo rate is the rate at which which RBI will lend to banks. So this has been set as 5.5%. Earlier it was 6.5%. It has been dropped from February till June to 5.5%. That is a 100 basis point drop. And then we have another rate called standing deposit facility rate at which banks deposit money to RBI. And then there is a marginal facility rate called 5.75% at which emergency borrowing is done by bank from RBI. Now friends, why these rates are so different? If you look at the lowest rate is 5.25% and the marginal facility rate is 5.75%, and there is a difference of 50 basis point between these two rates. Now friends, these rates are set in such a way that the normal functioning of banks, of lending and borrowing, is contained within this window, which is called corridor window of 50 basis point. Because normally the banks will not need money from RBI. They will get a better rate when they negotiate with each other, right? So they do so because for every day there will be some excess of fund or some shortage of fund, depending upon how the day of a particular bank looks. So banks will lend with each other. Now, if any bank demands excess money than what RBI is offering, then the bank which is wanting money can go to RBI to get money at a fixed rate which RBI has set as a policy, right? And same thing is applied for lending also. So to ensure that the market works properly, this window of lending and borrowing is set such a way that the market is contained within this window period of 50 basis point. That's all, friends. I'm not going to go further on that. Now, friends, only one thing which I'm not going to talk about here, and for that I'm going to show you one chart which I have created, that these rates are going to impact short-term loans, not long-term loans. Long-term loans or long-term debt is driven by perception of inflation. Only short-term debts are getting impacted, and for that I'm going to show you this chart. Now if you look at this chart, I actually have blended on this chart. This is actually you will find in my website. If you look at, I have the repo rate, then I have got the inflation, and then I have the bond rate, the government bond rate. So if you notice here, as the rates go down, I'll show you. Earlier when the rates were low, you can see the short-term rates, bond rates for various duration, 1 year, 2 year, 10 years, 20-year duration, right? They were low. But the long-term bond rates are controlled by expected inflation. So only the short-term borrowing is going to be affected. That's what I wanted to say. You can go and experience this chart. Here is the inflation. Here are the bond rates for various duration, and here are the repo rate. And you can clearly see how these short-term rates are getting impacted, right? And I'm not going to go into the detail why short-term rates are getting impacted, why long-term. Otherwise, this video is going to digress into a different direction. So let's go now straight to my presentation. So the presentation is RBI repo rate cut, limited impact on telecom, bigger win for the government finance. This is the title. This is basically you can say the summary of my presentation. There won't be much impact. But the government has reduced rate to fulfill their obligation, their interest. And I'll show you why, right? So we are going to analyze the real beneficiary for monetary easing and how much leverage RBI has. That also we are going to analyze, and what is RBI trying to accomplish through this rate cut. So what RBI has done, which we have briefly explained, I have explained, that the committee have reduced the repo rate by 50 basis point, and this is a single one tranche decrease, one single tranche. But earlier there was two tranches of 0.25 and 0.25, which you can go and look into my chart. So if you see here, the rate cut started from February, 6.25. Earlier it was 6.5, and now it has been set as 5.5%, right? So you can clearly see from my chart. Now, CRR has been reduced. I'm not going to talk about CRR. It's called cash reserve ratio. What is the purpose of cash reserve ratio? Just to pump more liquidity. Earlier, it was set at, I think, 5.5%. Now it is 4.5%. So policy stand has shifted from accommodative to neutral. Accommodative means that when you are more interested in driving growth than containing inflation, if you feel that the growth actually is not up to the mark, then these rate cuts probably will be able to drive growth, right? But now what RBI has done, after having taken this drastic step of reducing rate, now they have changed their stand to neutral, means they will be much more watchful. They will not be going and reducing rate further unless and until they get a signal then things are improving, because nothing is in control of RBI now. Right? It has been clearly, if you look at the governor statement, and I'm going to show you the governor statement. This is very important to look at. It says that after reducing the policy repo rate by 100 basis points in quick succession since February 2025, under the current circumstances, the monetary policy is left with very limited space to support growth. So from now onwards, MPC will be careful in assessing with the incoming data and will take action based on the. So this paragraph is very, very important in the governor statement. See, governor statement of 6th of June 2025, right? So RBI front-loaded easing amid softening inflation and sluggish investment. So they have just front-loaded. They have done some drastic cut, which they could have done on a much more broader window period. There was no need to do 50 basis point. They could have done 25 basis point and then 25 basis point in the next opportunity, but they have front-loaded, right? Because they wanted to because the inflation has softened, right, which we can clearly see, and there is a sluggish investment has not increased, and that's why the RBI is concerned. So RBI's inflation outlook for of FY 26, though the inflation has softened, but it is still within the upper level of the corridor, 2 to 4%. You know that. See, this is what I can make out from the governor statement. If you go to the governor statement and if you read it, and you should read all these things, it's very, very interesting, and you will find that there is a clear mention. So GDP growth mention is also there, and inflation targets are also mentioned here. There is somewhere there in that, I don't know, I don't want to waste time, but you will find it here, which I've captured here. So quarter-wide projections is then April to June 2.9%, then 3.4%, then 3.9%, then 4.4%. And that is why I'm saying that inflation, though had reduced, the overall inflation rate is still on the higher level. It is basically close to the upper corridor of 4%, right? It is close there, and it actually overshoots in Q4 2024. So therefore, it is not a very, very, you can say, the situation is not as conducive and as good that RBI would have liked to, because it is still very, very high, and there are risks. Evenly balanced, monsoon, global oil, tariff remains watch point. So then another problem that I see here with the RBI rate cut, what is the purpose of rate cut? The purpose of rate cut is to focus on growth, because as you cut rate, the short-term liquidity, at least the short-term liquidity, becomes much more affordable, cheaper. And therefore, people tend to borrow, and when they borrow, then they invest, and then when they invest, the production increases, and then every economy gets a fillip. But what I found in this report is the quarterly GDP projections, which is 6.5, 6.7, 6.6, and 6.3. So it is round about 6.5%, which is not a significant level compared to what we saw in the earlier financial year. So if you look at my chart about GDP, I think I have pulled out this chart of GDP. I don't know whether I have it. This is the GDP. So if let me just let this chart come up, because there are so many charts, sometimes I get myself confused. So growth, let's look at the growth. You'll see that, and this is the current. Let me just take GDP constant, and you'll see that and let me just do a yearly growth. That will give us. So you'll see that FY22 it was 9.8, FY23 it was 7.6, then 9.2, then 6.5. Then we have another 6.5. So we are not able to drive growth. So this rate cut is to prevent this GDP growth going down further. That's what I think is believed. So it is not basically giving a fillip to GDP growth, right? So these projections signal no breakthrough growth rather than a plateau at the current level. So we want to. So RBI may be, driven towards cutting rate because they are getting wrong symptom that GDP growth may go down further. It is not trying to drive GDP growth further to beyond the level of 6.5, which is a matter of concern. And that's why I don't think that there will be a significant gain, right? On any company, leave aside telecom, right? Indicates rate cuts are not expected to trigger a demand-led GDP surge, which is very clear. Otherwise, these projections should not have been done by the RBI governor. So many growth bottlenecks lie outside RBI control, which I shown you, the governor's statement, global trade, weather, physical constraints, etc. Now, why RBI rate cuts? Official explanation is what? So they have made some official explanation. Inflation has slowed down. They are quite happy with the inflation. So if you look at this chart, this clearly gives you, so this chart, the inflation data is available till April 2025. So you can see that from January, the inflation has slowed down for 3 consecutive months, we have got inflation below the RBI upper corridor of 4%, right? Now, the growth momentum needs policy support. They are really concerned that the GDP should not go down further. That's what I think is going on. Aim is to stimulate private consumption and investment, easier credit environment to support industrial activity. Now, telecom sector impact. Let's understand the telecom sector. Now, as I told you, friends, in the beginning of the part of the video, these rate cuts impact only short-term lending. You see the bond rates. You can clearly see that as the rates were low, the short-term lending for short duration actually got impacted. But the long duration lending yields remain high because those are driven by expected inflation, right? So therefore, telecom is mostly long-term debt. They are not short-term debt. Therefore, the outflow as regards rate cut on the long-term debt is not going to change much. It may change in 1 or 2 basis points, not much, right? And the VI's debts are mainly DOT debts, which are already fixed percentage. They don't have private debt. So VI is not going to get impacted at all. So they need bank debt, and their bank is not lending. Forget about the interest. The bank is not lending because they are concerned that the government dues are going to fall within the period of their debt and their money is going to get locked up in VI. So the VI is completely immune to rate cuts. It doesn't matter to VI. Another thing is weak transmission. The weak transmission means the overall lending structure of the economy. Whether it is driven by long-term lending, short-term lending, whether the banks are willing to pass on the benefit of this rate cut to the industry or not, those things are pretty important. Sometimes what happens is that there is a phase lag between when the RBI reduces rate and the banks taking action. Looks like that immediately the transmission is going to be very weak. Maybe after a certain period of time, we can see certain amount of fall in interest rates. But there was a drop of only 6 basis points on fresh loans, and outstanding loans only fell by 17 basis points compared to 100 basis points of rate cut. So there is a marginal benefit even for Bharti and Jio because these are long-term debt-driven company. It does not matter. The short-term debts are not going to matter. What will matter for Bharti Vodafone Idea is whether the consumer spending capability, right, discretionary spending capability get impacted by fillip in the economy because of the rate cut. Means if the industry gets cheaper loan, they are able to increase the supply side, the inflation reduces further, the products which are costing very, very high, the consumers spend low in those products, then they can spend money on these telecom services. Otherwise, they will not spend because unless and until their disposable income becomes much more relaxed or in a comfortable zone, then only the spending in telecom services will increase, otherwise not. Therefore, If you see here what RBI governor is saying, I'm picking up from RBI governor, we are yet to see a perceptible transmission in the credit market segment, though we must keep in mind that it happens with some time lag. And this is RBI governor's statement. So no immediate boost to telecom revenues. Why? Consumer telecom spend depends upon disposable income, inflation stability, employment, and income growth. Repo rate cut doesn't directly affect this variable. These are more policy and structural issue. RBI doesn't have any control over these variables. Thus, ARPU movement of subscriber expansion is not guaranteed unless there are some structural improvement in the overall system, which is not going to be done through rate cut. Just by one day, rate cut may help, but that is not the only criteria or only thing which triggers these factors. So what actually drives consumer spend? Stable job, rising wages. Unless we see rising wages, because when I say rising wages means the more demand. Industry needs more people. So they are willing to pay more to their employees. When the employees are getting handsomely rewarded, then only the disposable income will increase. Na? So otherwise they will not. Confidence in future earnings. There will be some confidence that, oh, the things are improving. There will be demand. So the whole cycle is interrelated with each other, right? So therefore, structurally, your economy has to be strong. You have to cut wasteful expenditure. We don't waste money in BSNL, which is not working, or spend money more efficiently. At least get something done from those funding that you're doing, rather than just making marketing claims. We need to be more, mindful of the fact that whatever we do in an optimal fashion. Government-led rural scheme like skilling, MSE support, sustain low inflation, especially in food. Like, for example, if you look at in one of my slides, I'm going to show you, which is very strange. So I have this CPI slide. I don't know whether I have it or not. Inflation, I think I have not pulled out. So I will not waste my time here. So let's go straight to this. So what I was trying to say is that the inflation actually has been driven down only because of vegetable inflation. Now, vegetable inflation has got contained, I don't know how, because that's a perishable item. So if you look at the overall inflation, you'll find that the vegetable inflation has gone down. That's why the inflation has gone down. The other item inflation, actually, their weighted average contribution to the general index, that has remained largely same. They have not changed. So if you have a food inflation driven by vegetable, which is a perishable item, I don't know how the things will change in future. Maybe the monsoon becomes bad or something happens. I don't know, right? So tax reliefs and targeted transfers, right? So who is going to truly get benefited by this rate cut? Let's understand this. This is very, very important. I'll tell you, Government of India. Why? So let's go to my chart. Again, this is going to be very interesting. So if you see my chart, the Government of India accounts. Now, in Government of India accounts, one of the most important thing is interest payment. Now, if you see the budgetary estimate for FY26 of interest payment is how much? 12.76 lakh crores. So 12.76, and it has been going on increasing from 11.38 lakh crores budgetary estimate for FY25, and then before that FY24 10.5. So you can clearly see that the interest payment has been increasing exponentially. So government is worried to bring this interest payment down, and there is a sizable proportion of this interest payment because of short-term loans. So I'll show you how the government deficit is financed. Now, if you look at here, you'll find that the overall deficit of government is what? It is going down. It was 17.55, then 35, then 15.7. Now it is 15.69. Not very significantly down from what we had in FY25. You see this number. And if you go to the finance, how this deficit is financed, you will find that out of the total deficit of 5.69, which I spoke about, there is a small portion of external funding. Then there is domestic funding of 15.45. And then you will see 11.54, which is substantially higher from 9.55 in FY25, is for market borrowing. So when you do market borrowing, then only you have to pay interest, and that's why your interest is going up. And if you do rate cut, then at least your short-term interest rates expenditure goes down. So the government is the biggest beneficiary. So you look at, this is the overall government capital and revenue expenditure, right? You see in FY25, this number, the grand total was 47.16 lakhs. Now it is 50.65 lakh, out of which 12.76 lakh crores is interest payment. So if you divide 12.76 lakh crores divided by 50.65, this is how much? 25.19% interest. So 1/4 of your spend is interest payment. And if you can drive this down, you are deeply benefited, right? So the government of India is the biggest beneficiary. Lower short-term interest costs, reduce outflow in service and fiscal deficit, right? And then we have got banks and NBFCs. They are also similar. And the market valuation, by the way, as the cost of borrowing in the short term goes down, then enterprise value of the company increases. Because what happens is that when you do discounting of debt, you use a discount factor which is being driven by the market rate of debt, which will increase your valuation of your company, enterprise valuation of a company. So the summary is why rate cut has little impact on telecom, because telecom sector will see little or negligible impact on EPS, which I have explained to you because of the reason. Because revenues are not going to increase, because revenues are driven by consumer. If the consumer doesn't have disposable income, why would the revenue increase? So revenue boost is unlikely without structural approach. Rate cut can't fix supply side issues to generate demand, right? So real driver is lowering government borrowing cost. That is the main thing. And demand revival requires job creation, investment, and inflation control. So limited space for future cuts, as RBI said, the governor said that from an accommodative they have gone to neutral. So we don't even know whether the rate cut going to go down to the level what we saw earlier. So if you look at this, you'll see that this was the rate earlier 4%, and this was the level in April 2022-21, right? At this level year FY 21-22. So there the interest costs, the short-term interest costs are quite low, but we don't know whether we will be able to reach those levels or not. So we don't know. Therefore, limited space for future rate cuts. RBI has already done 100 basis point cut. MPC change is stand from neutral and signaling cautious. There are global risks of trade war, weather, oil, which is not in RBI control. Supply side constraint need government intervention, not monetary easing. Hence, further rate cuts are unlikely unless there is a growth goes down drastically further. As I told you, the focus is to ensure that the GDP does not go down below 6.5%. That's why the RBI has intervened. Otherwise, they would not have, right? This front loading which they have done is because of that. So rate cut helps smoothen government borrowing cut, but they can't substitute real reforms. And telecom and economy need structural enablers, not just cheaper loan. That's not going to help the telecom sector, friends. So this is the end of my presentation. I hope that I have made my point very clear. I have tried to zip the whole complex story in a very small window of time. I hope that you have liked this video. And if you have any comments, let me know in the comment section. And many thanks for listening till the end. Thank you very much. And I'll come with a new video next time on a new topic.